Hey there, welcome back to Legend Finance, where we help turn you into a finance legend. Have you ever considered getting a home equity line of credit, also known as a HELOC? If so, it's good to weigh the pros and cons first. So what's a HELOC anyway? Think of it like a credit card that's linked to the equity in your home. Now, can it be helpful to consolidate things like credit card debt or personal loans? Absolutely, especially if those have high interest rates. But what about using a HELOC for home renovations, retirement funding, or just everyday expenses? It can be a useful tool for sure, but you'll want to tread carefully. Remember, it's secured by your home, so there's a risk involved. And here's the million-dollar question: should a HELOC be part of your journey to financial independence? Well, it's different for everyone, and it really depends on your personal financial situation and risk tolerance. It's always a good idea to have a chat with a financial advisor before making such decisions. Gotcha. So you're wondering what a HELOC really is, right? Well, imagine if your house were a giant piggy bank. A HELOC basically lets you, the homeowner, crack open that piggy bank and take some money out, all while keeping the house. The catch? Your house acts as a safety net or collateral. And how much moolah can you pull out? It all hinges on how much your house is worth. If you've got equity built up in your home, a HELOC gives you the freedom to access those funds over a long stretch without having to put a for sale sign in the front yard. By the way, it's not just for your primary home. You can get a HELOC on an investment property too, though that's a bit more tricky. Lenders tend to be a bit more strict, and the interest rates might be higher. It sounds like something worth discussing with a financial expert, wouldn't you say? Okay, let's make sure we're on the same page. Home equity loans and HELOCs might sound similar, but they're not twins, more like cousins. With a home equity loan, you're getting the whole chunk of cash in one shot, straight from your home's equity. You've then got to pay it all back, principal and interest, over a time span ranging from 5 to 30 years. Here's a quick example. Let's say your home is worth $400,000, but you still owe $300,000. So your home equity, that's the part of your home you actually own, is $100,000, right? Lenders usually let you borrow up to 80 or 85% of this amount. So in this case, you could get a home equity loan for about $80,000 to $85,000. Simple as that. So if you're wondering what a HELOC really is, well, imagine if your house were a giant piggy bank. A HELOC basically lets you, the homeowner, crack open that piggy bank and take some money out, all while keeping the house. The catch? Your house acts as a safety net or collateral. During the draw period, which usually lasts between 5 and 10 years, you're only required to pay the interest each month. So it's more flexible, and you can borrow just as much as you need, when you need it. But don't forget, all good things must come to an end. When your draw period is up, after those 5 to 10 years, depending on your agreement with the lender, your HELOC enters the repayment phase. It's time to start paying back what you borrowed, not just the interest. Now, when it comes to the repayment period, it's a different ballgame. You won't be able to pull out any more funds, and the payments each month won't just be for the interest, but will also include the original amount you borrowed. Imagine you reach the repayment phase and there's zilch, nada, zero balance in your HELOC. Guess what? Your account typically gets closed automatically. But what if there's still a balance? That's where it gets a bit tricky. You've got to keep an eye on when your draw period ends, because as soon as you hit the repayment phase, you need to start paying back not only the interest but the principal too. And trust us, it's something you need to budget for, as it can make a pretty significant dent in your wallet. This repayment period can last anywhere from 10 to 20 years down the line, so it's crucial to plan ahead. Great, let's dive into some real-life HELOC examples. As a group, we're exploring the idea of applying for a HELOC. So here are some questions we might want to ask and find answers for. All right, first up, we want to know whether the HELOC we're considering offers a fixed rate option on the balance during the repayment period, or if it's just a variable rate. Is there a limit on how high the interest rate can go? If we can lock in a fixed rate as we head into the repayment period, that might save us a good chunk of change on interest. It's definitely worth asking about, wouldn't you all agree? Okay, more questions are on our list. Is it possible to switch some or all of the variable rate HELOC to a fixed rate loan without having to pay a fee? How much can we take out initially? Is there a minimum draw amount? Here's another thing to consider. Can we get a discount on the interest rate with the lender if we open other accounts like checking or savings? How about the length of the draw period? And what are the options when it comes to the repayment period? It seems that 5, 10, or even 20 years are common terms for repayments. There's lots to think about, right? But getting these answers will help us make the best decision. And let's not forget to check the maximum line of credit the lender will allow us to have. After all, a HELOC is similar to a credit card in that sense. We should also look into what the annual fee is during both the draw and repayment periods. You never know, some banks might even waive initial annual fees. And of course, we shouldn't overlook the closing costs, if there are any. Are there any penalties if we decide to close our HELOC early? And last but definitely not least, do we have the option to refinance? Okay, here's a scenario for us to consider. Imagine we've got a house worth $400,000 and we're thinking of using it as collateral to open a HELOC. But we're only willing to go up to 50% of the home's value minus what's still owed on the mortgage. For simplicity's sake, let's say we still owe $200,000 on the mortgage. That leaves us with $200,000 in equity. So 50% of that would be $100,000. We're sticking to a 50% loan-to-value ratio here just to keep things straightforward. Got it? Great, let's move on to the next part. So based on this scenario, we'd have a line of credit of $100,000. We're looking at a variable interest rate of around 7% or 8%. This rate assumes that our collective credit score is excellent, 760 or higher, and is in line with the current federal funds target rate of 3% as of 2022. As for the terms, we're talking about a typical setup here with 10 years of draw period and then 20 years of repayment period. Anyone following so far? Great, let's continue our HELOC journey. So if we make an initial withdrawal of $10,000 when we open the account, we're probably looking at owing around $100 per month in interest payments for the next 10 years during the draw period. This would also include the annual fee for our HELOC. But remember, this $100 a month could change based on the prime rate. It's super important to remember before we open a HELOC that we need to treat it like a credit card. If we carry a balance from month to month, we're going to owe interest. It's just something we need to keep in mind as we go about this process. HELOCs are usually tied to variable rates, so these rates can change along with the prime rate. Take 2022 as an example. We saw those interest rates climb because the Federal Reserve tightened up its monetary policy. During that draw period, our HELOC is going to be doing a dance with the prime rate. One day it's at 5%, next month it might leap to 6%, and who knows, by next year it could even reach 7%. It's like a roller coaster ride, courtesy of the Fed's decisions. Our interest payments could be up one month and down the next. And here's a little insider tip. Typically, the prime rate is just the federal funds target rate plus a neat 3%. So if the Fed funds rate is chilling at 3%, then we can bet our boots that the prime rate is going to hang around 6%. It's pretty handy to remember this while we're navigating our financial adventures. HELOC pros and cons. Pros. 1. Access to cash. It's a great way to access a large chunk of cash for big expenses, like home improvements or college tuition. 2. Lower interest rates. Typically, the rates are lower than credit cards or personal loans. 3. Tax deductions. You may be able to deduct interest if you use the money for home improvements. Cons. 1. Risk of losing your home. Since you're using your home as collateral, if you can't pay it back, you might lose your house. That's pretty scary. 2. Fees. There could be upfront costs or annual fees. These can add up. 3. Variable interest rates. Rates often change over time, which can increase your payments unexpectedly. Ouch. So make sure to weigh these pros and cons and your ability to pay back the loan before making a decision. Cheers! So wrapping up today's chat about home equity lines of credit or HELOCs, these can be a flexible option for homeowners looking to leverage their equity, often with lower interest rates than credit cards or personal loans. Remember, they can also come with potential tax benefits if used to improve your property, but always consult with a tax advisor. However, the flip side is that your home acts as collateral. This means if payments aren't maintained, your home is at risk. Additionally, these lines of credit require discipline, as it can be tempting to borrow more than needed. And don't forget about those fluctuating interest rates, which can affect your repayments. In conclusion, a HELOC can be a significant tool for financial flexibility when used correctly and responsibly. It's crucial to understand both the advantages and potential pitfalls before diving in. Well, that's it for today. Please make sure you hit like, share, and subscribe to keep up to date with all things finance. Knowledge really is power when it comes to managing your money. Until our next chat, stay legendary.